Welcome back, guys. Today we're going to take a look at Sealed Air Corporation. They're currently trading at $37.50 a share. Over the past 5 years, they're down 12%. Maybe this offers a buying opportunity. They definitely haven't kept pace with the S&P 500. Let's take a look. They are a $5 billion company. One of the smaller companies that we've looked at on this channel. Price earnings ratio of 15. That's not too bad. That's pretty average. A little bit lower than current market conditions, and dividend yield of 2%. So let's take a look at their growth. Take a look at their revenues. They basically just make packaging for like red meat and stuff like that. So it's sealed air. So like they take the air out of bags and they package them with plastic. Yeah. Anyway, let's look at this revenue here. They had some growth, looks like, except in the last year they declined. So looks like they're probably just keeping up with inflation for the most part. I would expect maybe 2% moving forward, just to keep up with inflation. Their margins are decent. I mean, they're pretty consistent for the most part. They make money every single year, so that is always a good sign. You always want to be making some money. Looks like they've been doing some share buybacks. That's good to see as well. Their balance sheet, they do have 4.4 billion in debt, and they took on debt into 2023. Maybe they did an acquisition here of some sort, or maybe they built a new factory or something. But their net debt did jump a little bit. And cash flow, they do pay 115 million in dividends, and they buy back some stock with whatever's left over, it looks like. Otherwise, they do have debt that they have to pay down. It looks like they took on some debt last year. Let's check out their stats, look at their margins here. Their ROIC is going to be around 7 to 13%. So actually not horrible. Gross margin around 30%, operating margin 16, and net margin is going to be between 6 and 8%, 6 and 9%. I would probably expect like 7% on average moving forward. That's what I'm going to use in my model. Anyway, let's look at what the analysts are thinking. Analysts are expecting 2.91 going to 3.27 in their earnings, which is kind of impressive that they think it's going to grow by that much. And same with the revenue. They think the revenue is going to grow by 3%, even though they did decline in revenue by about 2% last year. So yeah, they do expect the revenue to grow into 2025, and I probably expect 2 or 3% moving forward. Checking out their short percentage, let's see. Ooh, a short percentage of 5%. That is fairly high. That's kind of a red flag. Probably would avoid this business just based on that number. That's kind of bad, especially for a business that's so consistent like this one. Maybe it has to do with debt maturities. That could have something to do with it. Let's go to the DCF model, take a look at that. So I put the earnings estimate, revenue estimate here, buybacks. They actually do, yeah, they do a few buybacks. So I put 150 million there, net debt of 4.4 billion, discount rate of 10% because I want a 10% return on all of my stocks. Exit multiple of 15. They're currently trading at around there, 14.5. I think 15 is fair for this business just because they'll stay steady and you'll probably see them just keep up with inflation. So I think 15 is fair. Now we're looking at growth of 2% in their earnings from their earnings estimate here, and we're looking at a fair share price of $38. However, they do have a lot of debt. When you factor in the debt, I'd probably put them around $25, $30 a share if you just took the average of these two. Usually with businesses that are really consistent like this, that's not really a huge issue. However, it does have to get paid off at some point. And if you're just going to keep rolling it over and maybe you come into a time like now where their interest rates are a little bit higher, that can be kind of annoying. So yeah, you always got to watch out for debt on businesses, but yeah, I'd probably put the number between these two. And same with the revenue margins model, growth of 2%, profit margin of 7%, and the fair share price comes out to 35. So this is an overvalued business. However, it's not going away anytime soon. I mean, packaging industry is going to be around for a long, long time, and you're probably just going to collect that 2% dividend, and it will probably grow slightly the dividend over the years. Maybe you won't see too much share appreciation. Yeah, I probably would not buy this stock. It's going to be low growth. You won't see very good returns in this for the most part. But yeah, that's what I think. Make sure to let me know what you guys think in the comments. I just think that there's better businesses to buy than this. Like basically, okay, there's businesses that are definitely worse than this, but there's a lot of businesses that are better. So yeah, make sure to hit that like button, and I'll see you in the next video.